Welcome, everyone. My name is David Weinstein, Director of the Center on Japanese Economy and Business, which we call CJEB at Columbia Business School, and the Carl S. Schaut Professor of the Japanese Economy at Columbia University. On behalf of CJEB, I want to welcome you to our webinar, Central Banking in the COVID-19 Era. Our chairman, Hugh Patrick, who is in the Zoom audience today, sends his regards as well. He has been involved in these webinars since their inception and is proud of their success. All of us at CJEB sincerely thank you for being with us today, in spite of the difficulties caused by the pandemic. We would also like to express our immense appreciation to CJEB's sponsors for their generous donations and continued support. This funding is essential, now more than ever, as we continue our mission in this time of crisis. Before we get started, I will give a brief introduction of CJEB. The center was established in 1986 by Professor Hugh Patrick, and in July 2019, he took on the new role of chairman, and I became the new director. Our mission at CJEB is promoting knowledge and understanding of Japan's economy and its business systems in an international context. I am proud to say that we have evolved and adapted to the world's new normal by shifting to an online format so that we can continue to pursue our mission. We are well known for our research activities and also for our international symposia, conferences, and lectures that provide high-level experts from the public and private sectors, forums for collaboration and reflection on Japan, the United States, and the global economy. We are unique in North America as the only research center that specializes in Japanese economics and business systems in an academic setting. I think we can agree that one of the few positive outcomes that has arisen from this horrible pandemic is the fact that we are now able to dramatically increase our reach and accessibility through this and other outstanding webinar series. I want to thank Takatoshi Ito for organizing this current series. Now, you no longer have to be on Columbia's campus in order to enjoy our events, or even in New York. This has resulted in a massive increase in our outreach. For example, the audience of today's events is around 1,300 people registered from around the world. At last count, we have people tuning in from 6 continents, representing 40 countries. In other words, if you are uninterested in today's event, you are most likely a penguin from Antarctica. Today's webinar is part of the Japanese Economy in the COVID-19 Era series. These remarkable webinars were set up in response to the COVID-19 pandemic and are aimed at helping us to adjust and improve our new normal. The first 2 were conducted in Japanese and generated a great deal of discussion. Now we are in the English phase of this series, which has been incredibly successful as well. We thank all of you who are returning viewers from previous webinars, and we welcome those of you who are joining us for the first time. Now on to today's topic, central banking in the COVID-19 era. My role is to introduce Takatoshi Ito, who will then introduce our distinguished panelists. Professor Ito is director of the program on public pension and sovereign funds at CJEB, and a professor at the School of International and Public Affairs at Columbia University. Taka, thank you very much for being here today. The Zoom channel is yours.
Thank you, David. Hello, everyone. I'm Takatoshi Ito, director of the program on public pension and sovereign funds at CJEB, and professor at SIPA, Columbia University. As David explained, today's topic is central banking in the COVID-19 era. And today we are honored to be joined by world-renowned panelists, and we look forward to hearing their perspectives. Our first speaker will be Governor Haruhiko Kuroda, Bank of Japan. And before he took up this position in 2013, he was president of Asian Development Bank. And before that, he was briefly professor at Hitotsubashi University. And before that, he was vice minister at for international affairs at Ministry of Finance. And I had real pleasure to working with him about 20 years ago as deputy to him. So he's a real expert in international finance, monetary policy, development economics, and so on, and also international taxation. Our second speaker will be Dr. Janet Yellen, distinguished fellow in residence with the Economic Studies program at Brookings Institution and former chair at Federal Reserve Board. But she also has many roles before she became the chair at the Federal Reserve Board. And I cannot do justice mentioning her previous positions, but president at San Francisco Fed and CEA chair, among many roles. And most importantly, she was my first year macroeconomics professor many years ago at Harvard University. And we are also joined by Dr. Patricia Mosa as a discussant. She's a director of MPA Programming in Economic Policy Management and senior research scholar at School of International and Public Affairs at Columbia University, my colleague. And after their remarks, we will have a Q&A session to address questions from audience. But before I pass on my role to Governor Kuroda, I would like to share some charts so that we have the common grounds to discuss. So right. So first one is the balance sheet of the central banks. And this is to have the 2006 as starting point as normalized at the January 2006. And during the global financial crisis, that we had a real jump in the balance sheet in the Federal Reserve and also ECB. Bank of Japan didn't do much around that time. After Mr. Kuroda took office as the president of the governor of the BOJ, the Bank of Japan's balance sheet started to go up and continue to go up. The Federal Reserve, FRB, has the QE1, QE2, QE3, and sort of tapering before this COVID crisis hit. And then again, the balance sheet is jump up. Some people doesn't like this graph and wants to normalize with a nominal GDP. So against nominal GDP, the BOJ has a very large balance sheet, and the Federal Reserve is relatively small in terms of nominal GDP. Okay, so depending on how you want to look at it, these are the charts on the balance sheet, central bank of balance sheet. This is Japan's inflation rate, and before Governor Kuroda took office, that Japan was basically in deflation. That is the below zero and inflation rate. And after the Governor Kuroda took office and Abenomics was introduced, and mostly it was inflation rate has been between 0 and 2. 2 is a target, but target has not been achieved, but fluctuating in the positive territory. And in the COVID crisis, looks like it's going back to negative territory, but hopefully we're gonna go back up in the positive territory. But 2% target has not been achieved. We're gonna discuss that later. And this is yield curve control in Japan, which we call YCC. And it says around the 10-year bond rate will be controlled around 0. And there is a band around it, which market believes that within plus minus 0.1, and later it was widened to plus minus 0.2. But it's not explicitly mentioned in Bank of Japan's policy instrument target, except it's around 0.0. Okay, so with these background, I'd like to give the floor to Governor Kuroda for his initial remarks. Governor Kuroda.
Okay, thank you, Professor Ito. It is, of course, a great pleasure to participate in this webinar. Today, I will talk about the Bank of Japan's responses to the impact of COVID-19. The global spread of COVID-19 has had a severe impact worldwide. Global financial markets became rapidly unstable from late February with deteriorating investors' risk sentiment. Domestic and overseas economies became depressed significantly in the first half of the year because economic activity was restrained or constrained by preventive measures taken since March, such as stay-at-home orders and business suspension. Government and central banks responded this situation swiftly and aggressively based on their experience with the global financial crisis through international cooperation. For instance, as for central bank's action, the enhancement of the US dollar operations is the outcome of international cooperation. Although the details and size of the responses to the current crisis vary among central banks, they are based on two common perspectives. One is ensuring smooth corporate financing through fund supplying measures to support lending and purchases of CP and corporate bonds. The other is stabilizing financial markets through large-scale provision of liquidity, including asset purchases. In line with these perspectives, the Bank of Japan has enhanced monetary easing since March and implemented the following three measures. The first is the special program to support corporate financing. The total size of this program is about 120 trillion yen, or about 22% of GDP. It consists of purchases of CP and corporate bonds with the upper limit of about 20 trillion yen, and the special funds supplying operations, which can amount to 100 trillion yen. Through this operation, the Bank of Japan provides funds on favorable terms to financial institutions that make loans in response to COVID-19. This operation also includes a scheme in which the government takes the credit risk while the bank provides liquidity, thereby supporting financing together. The second is ample provision of the yen and foreign currency funds. As for the yen, under the yield curve control, the Bank of Japan decided to purchase a necessary amount of JGBs without limit. Regarding foreign currencies, the bank has provided ample US dollars through the enhanced US dollar operations. The third is active purchases of ETFs and J-REITs. The aim is to prevent firms and household sentiment from deteriorating through volatility in financial markets, thereby supporting positive economic activity. Regulatory responses also have been made to ensure financial system stability. Based on an international agreement, full implementation of the finalized Basel III standards has been deferred by 1 year, and banks have been encouraged to use their capital and liquidity buffers. Moreover, the Bank of Japan announced with the Financial Services Agency in April an easing of the leverage ratio requirement. These responses have been effective. Although financial markets are still nervous, tension has definitely eased. Premiums for US dollar funding, which expanded through the increased demand, have declined. Although corporate financing is still distressed, the environment for external funding has remained accommodative. Financial institutions' lending attitudes have remained eased, and issuance conditions for CP and corporate bonds have been very favorable, as seen in the narrowing in issuance spreads that expanded temporarily. Under these circumstances, the year-on-year rate of increase in the amount of outstanding of bank lending has been about 6.5%, and that of CP and corporate bonds has been exceeding 10%, with both at high levels. Now, let me turn to the outlook for Japan's economy. The spread of COVID-19 has not subsided globally, and domestic and overseas economies have remained in extremely severe conditions. However, since many countries have been resuming economic activities gradually while containing the spread, the situation has changed slightly. In Japan, after the government lifted the state of emergency in late May, economic activity has resumed gradually. Despite extremely high uncertainties, domestic and overseas economies are likely to improve gradually from the second half of this year. However, the pace of improvement is expected to be moderate, since preventive measures will constrain or restrain economic activity while vigilance against COVID-19 continues. In our July outlook report, we projected that the growth rate of the Japanese economy this year, or fiscal 2020, would be in the range of minus 5.7% to minus 4.5%. But in fiscal 2021, growth rate would enter the ranges of 3 to 4% positive, and 1.3 to 1.6% positive again for fiscal 2020. The inflation rate is likely to be negative for the time being, mainly affected by COVID-19 and crude oil price declines. Thereafter, we expect that the economy improving and the inflation rate is expected to return positive and then increase gradually. The CPI for all items excluding fresh food is projected to be in the range of minus 0.6 to minus 0.4% for this fiscal year 2020, but would be positive 0.2 to 0.5% for fiscal 2021, and positive 0.5 to 0.8% for fiscal 2022. Of course, this outlook entails extremely high uncertainty since it depends on the consequences of COVID-19 and their impact on domestic and overseas economies. If the strict public health measures are reinstated, economic activity could be constrained significantly again. Moreover, attention should be paid to whether the second round effects of a shock from COVID-19 will significantly depress the economy. Specifically, whether the liquidity problem would shift to a solvency one and affect the financial system, thereby further pushing down the real economy, should be monitored. It also matters whether farms and household growth expectations will decline, leading to cautious spending attitude. At present, it seems possible to avoid these risks owing to the government and Bank of Japan's responses, but further developments warrant us attention. Lastly, let me touch on the bank's thinking on future conduct of monetary policy. The Bank of Japan considers it important to continue providing support for financing and maintaining stability in financial market by conducting the three measures which have been effective. Since the economic and the financial impact of COVID-19 is highly uncertain, the bank, for the time being, will closely monitor this impact and would not hesitate to do whatever it takes as a central bank if necessary. Thank you.
Thank you very much, Governor Kuroda. And Dr. Yellen, would you please share your thoughts with us?
Yes, thank you so much, Taka. And it's a pleasure to be with you for today's webinar. I'd like to briefly describe the Federal Reserve's response to the coronavirus crisis. In many respects, this recession is unique, but like all recessions, it's imposing heavy costs. Unemployment has risen to levels not seen in the post-war period, and many business owners' financial survival is at risk. The Federal Reserve immediately recognized these dangers and moved swiftly and forcefully to address this crisis. Starting with monetary policy, the Fed quickly lowered the federal funds rate nearly to zero in mid-March and indicated that it plans to keep rates low for several years. The Fed may well do more in coming months as reopening proceeds and as the outlook for inflation, jobs, and growth becomes somewhat clearer. In particular, to maintain downward pressure on longer-term interest rates, I expect the Federal Open Market Committee to provide forward guidance about the economic conditions it would need to see before it considers raising its target rate, as well as clarifying its plans for further securities purchases. I'd also note that the Fed has been conducting a review of its monetary policy strategy, and I expect that to conclude by September. I expect the Fed to announce an important change in how it interprets its 2% inflation objective. Instead of saying that it's always aiming for 2% inflation, regardless of how inflation has actually behaved and evolved in the past, I anticipate that it will indicate a desire for inflation to average roughly 2% over time. And that means that after a long period of inflation below 2%, such as we've had over the last decade, the Fed would consider it positively desirable to overshoot 2% somewhat on a temporary basis during the subsequent expansion. Hopefully, such a strategy will avoid slippage in inflation expectations and inflation itself over time. The Fed has also been active beyond monetary policy. First, the Fed has served as a market maker of last resort by acting to stabilize critical financial markets when capital or other regulatory constraints interfered with normal market making or arbitrage. In March, uncertainty about the pandemic led hedge funds and others to scramble to raise cash by selling longer-term securities. The surge in supply of longer-term securities, including treasuries, was more than dealers and other market makers could handle. So to stabilize these key markets, the Fed purchased very large quantities of treasuries and mortgage-backed securities. You saw the upward spike in Professor Ito's diagram that he displayed. And now risk and liquidity premiums in these key markets have returned closer to normal. Second, the Fed has served as lender of last resort to the financial system, which is a classic function of central banks. Fortunately, the financial system is in much better shape today than it was during the financial crisis. The Fed has nevertheless taken steps to ensure that the financial system, which includes not only banks and broker-dealers, but also money market funds, has sufficient liquidity to operate normally and to keep extending credit. The Fed largely replicated the 2008 financial crisis playbook. In addition, the Fed revived the program of currency swap lines with the 14 central banks that took part during the 2008 crisis. The broad availability of dollar liquidity is essential to support foreign banks that engage in substantial borrowing and lending of dollars in the US and globally. Third, the Federal Reserve, with the support of Congress and the Treasury, has also served during the current crisis as a lender of last resort to the non-financial sector, backstopping key credit markets disrupted by the pandemic. Using emergency authorities, the Fed revived financial crisis era facilities to stabilize commercial paper and asset-backed securities markets. The Fed has also added new facilities to lend to corporations and state and local governments and to buy outstanding corporate bonds. These programs actually have not extended much credit so far, but that does not mean they have not succeeded. By establishing these programs, the Fed has given private investors the confidence to re-engage by reassuring them that the government will not allow these critical markets to become dysfunctional. Indeed, the corporate and municipal bond markets largely stabilized after the announcements before any loans were made. And of course, if these markets seize up again, the Fed's programs can extend credit. The Fed also established the Main Street Lending Program to lend through banks to medium-sized companies. It's too soon, however, to judge its performance. This program is very different from anything the Fed has attempted before, and it poses difficult technical challenges. Questions remain about how many banks and borrowers will participate. And the Fed and Treasury may have to further ease terms for borrowers and increase incentives for banks for this program to have the desired effect. Well, I suppose a natural question is there more the Fed could do? As I noted, the Fed will probably provide more clarity about its monetary policy plans, and it may need to adjust the terms or borrower eligibility requirements of its various lending facilities. Broadly speaking, though, the Fed's response has been quite comprehensive. But as Chair Powell often notes, the Fed's authorities allow it to lend, not to spend, and some households and firms need subsidies or grants, not loans, to survive this challenging period. So fiscal policy also has a very important role to play. Thanks. Let me stop there.
Thank you, Janet. So the next speaker, actually discussant, is Professor Trish Mosa. Trish?
Hello, everyone. It's a pleasure to be here. And thank you, Governor Kuroda and Dr. Yellen for those very, very helpful remarks. I have a couple of questions related to things that I think both of you mentioned, at least in passing. And I've also noted in the Q&A session that there are a few audience attendees who have some closely related questions. So where I can, I'll fold in one or two of those. Let me start with central bank independence. Central banks around the world, the Fed and the BOJ in particular, have very substantially increased or committed to purchase more and riskier assets in response to this crisis. And they are directly providing credit to the non-financial sector, as Janet mentioned just a minute ago. But that also increases their risk. It nearly always requires more cooperation with the fiscal authorities, certainly in the case of the United States. And it's basically the central bank is in the position of picking winners and losers, if you like, in the private sector. I'd be interested in both of the panelists' views about whether this increased risk-taking could potentially threaten the independence of central banks' policy-making decisions in the future.
Okay, thank you, Trish. So we move to Q&A sessions, and some people have submitted questions in Q&A boxes. Some people have submitted before the seminar in the through the registration. So I will sort of aggregate those questions and put into my own term. And I should have mentioned in my opening remarks that Governor Kuroda is a true believer of inflation targeting. And Janet has been very instrumental in introducing inflation targeting at Federal Reserve. And so I'd like to start with this inflation targeting questions. And so it's a set of questions, I would say. And the first question to Governor Kuroda is that sort of the failure of achieving 2%, despite, I would say, everything you have done in the last 7 years, and QQE and QQE2 and negative interest rate policy and YCC and all those forward guidance communications, yet the Japanese economy is not strong enough. Consumers and corporations are not optimistic enough to have the economic activity strong enough to achieve 2% target. From your view, that what is your explanation why 2% has not been achieved in Japan? Governor Kuroda?
Yes, as just you pointed out, the inflation rate in Japan has not yet reached 2% target. There are various factors behind this. One of that is since inflation expectations in Japan tend to be formed adaptively, so that once actually inflation rate started to decline from summer 2014, mainly because of rapidly declining crude oil prices. Actually, price inflation declined, and then inflation expectations also declined. So this is one of the reasons why we have not yet reached the 2% target. In addition, there are a few fundamental factors, such as farms and households continue to be fairly cautious, particularly farms are cautious on wage and price setting. And this cautious attitude, which was, of course, created by almost 15-year-long deflation from 1998 through 2013. This cautious attitude has not yet completely eradicated. And also, as you may know, other factors such as room for a rise in farms' productivity and technological progress made in recent years are behind the inflation rate taking time to increase. This is somewhat paradoxical. It is good for real economic growth, but not so good for inflation rate reaching 2%. That said, I think Japan's economy, since the introduction of QQE in 2013, Japan's economy has improved significantly. And we are not in a sort of deflation that is continuous or sustained decline of prices. We are not in deflation. And although, as I said before, this fiscal year, inflation rate may be slightly negative, but next fiscal year, year after the next, we expect the inflation rate would become positive and gradually rise. So I think we have been trying to achieve the 2% inflation target, and we will continue to do so. And it took certainly more time than we hoped for, but I'm sure that we will achieve the target.
Thank you very much, Governor Kuroda. And to Dr. Yellen, same question in the sense that Federal Reserve is underachieving 2%, but not that far compared to Japan. But you also mentioned that there is a re-examination on, re-examination on how to phrase it to the public. So it's a communication issue for the guidance and so on. Actually, to that extent, to that question, Governor Kuroda has actually had introduced this overshooting commitment along with YCC back in 2016, but overshoot commitment has not been triggered so far. And so how much this overshoot commitment would change the US public inflation expectation? That's one question. And also the bigger question is that some people advocate that why 2%? Some people advocate 4% to have a bigger buffer to avoid the deflation. Some people think that if you have 1%, maybe 1% should be a target, both in Japan and the US. So why 2%? That is another question. So Janet, do you have any views on these points?
Let me try to address some of them. Thanks, Taka. Why 2%? At the time that we adopted 2%, a very careful study had been done on the costs and benefits of choosing alternative inflation rates. There are costs associated with high inflation, especially in a world where taxes aren't index that can interfere with capital accumulation. The costs of low inflation are particularly the inability to adequately address downturns in the economy by using monetary policy. It erodes the buffer that is available for monetary policy. When we undertook these studies, I think it's fair to say that the average level of interest rates had been a lot higher than it's been over the last decade. And the view that many of us now have that secular stagnation has pulled down the level of equilibrium real rates and that that's not something that's going to go away soon. We hadn't had that experience. And so 2% really seemed like an adequate buffer. And the truth is, we never would have expected to have a period of 7 full years with interest rates at 0 and now to be entering another such episode. So I think if we had done those calculations earlier, the answer would have been to ideally choose a somewhat higher inflation target. But I think inflation expectations have been reasonably stable around 2%. Alternative tools have been developed, particularly forward guidance and quantitative easing, to augment the power that monetary policy has. The Congress's mandate to the Fed is price stability. And well, one might argue, especially with biases and price indices, that 2% is effectively price stability. When you think about raising it to 4%, it would be very hard to argue that that is consistent with the mandate that Congress gave the Fed. Now, one could imagine reconsidering that mandate, but I'm not sure that it's a wise thing to do. You mentioned a lower target, 1%. And there are people who argue, look, you know, for the last decade, inflation in the United States has only averaged 1.5%. Now with the pandemic, it's again slipped below 1%. Why not throw in the towel and just lower the inflation target to 1%? And I know Governor Kuroda sometimes faces exactly the same questions. I think that that would be extremely unwise and very dangerous, because that would be just inviting inflation expectations to slip further and further eroding the buffer that monetary policy has to operate, given that the average level of nominal rates would fall along with the average level of inflation. And while there are other tools, adjusting short-term interest rates is the tried and true tool of monetary policy. So I'd say that the Fed has taken this issue very, very seriously in its review. Right now, we have a very depressed economy. I don't think there's much prospect in the next year or two of inflation moving above 2%. Of course, there's uncertainty, but it's not something I would forecast. So this changing the inflation mandate to be an average inflation target, I don't expect magically inflation to rise or inflation expectations to rise because the Fed makes some announcement about adjustments. But I do think that the kind of change I anticipate in the Fed's inflation target, which is a subtle one, inflation averaging 2% over time rather than the Fed just shooting for 2%, it will enable the Fed to offer new forward guidance. And don't know what the Fed's going to do. I don't have any inside information about that, but it would not surprise me if the Fed said something like this in the coming months. We anticipate that it will be appropriate to hold the Fed funds rate near zero and to continue asset purchases until inflation has returned stably to 2% and the rate of unemployment has declined to levels regarded as normal in the longer run. And such an announcement would be, in effect, I think, inviting an inflation overshoot. If the Fed were to wait that long to begin raising rates off zero, it is positively saying we would be pleased with inflation drifting above 2% in the context of a very tight labor market. And I think this is, in a way, the most the Fed can do. It would provide confidence to the markets that the Fed has a commitment to keep rates low, likely for a very long time, and that will spur recovery and push up inflation.
Thank you, Janet. So next question is also sort of the set of few sub-questions. Some people think that there's a limit to monetary policy with this low interest rate, and yes, the Federal Reserve and the Bank of Japan is doing a lot in stabilizing the financial markets and make sure that it functions well. But to lift the economy, monetary policy alone cannot do it. And the fiscal policy is more important. Well, how could monetary authority and fiscal authority coordinate? Well, if the central bank can hold the interest rate low and government can issue the government bonds and use those revenues to spend on the fiscal policy, that's one way to do it. But some people worry, this is related to Trish's question, that this is a dangerous territory for central bank. And if the central bank suffers losses from those lending program and also the long-term bond holdings, then that is a threat to the independence of central bank. So coordinate with fiscal authority and purchase government bonds. And some people say this is exactly what modern monetary theory, MMT, advocates, versus that there's a risk of on a balance sheet and leading to the central bank independence issue. So sorry to put many things into one question, but Governor Kuroda, do you have views on this?
I must say that the fundamental idea behind the Bank of Japan's monetary policy or monetary easing at this moment is completely different from MMT or whatever wild ideas. Because certainly the Bank of Japan purchases JGBs in large amount, but we purchases JGB as part of monetary policy and not as monetary financing of government debt. And of course, given the impact of COVID-19, the Bank of Japan has purchased JGB in order to maintain stability in the bond market and keep the entire yield curve at a low level. And through this, we think the Bank of Japan can support the economy and fulfill its role of achieving price stability. So this is basically monetary policy. But of course, as you said, not only Bank of Japan, but also other central banks in developed countries, they are making monetary policy very accommodative, keeping interest rate very low, including long-term interest rates. And that make the fiscal policy, fiscal expansion to counter negative impact of COVID-19 more effective. So it's kind of a policy mix with fiscal policy, fiscal spending, and monetary easing. But I must say that the government and central banks, with their own mandate and with their own responsibility, doing that. And I think so. So I don't think this kind of policy mix or coordination would make central bank less independent. I mean, anyway, the Federal Reserve or the Bank of Japan or ECB's independence is assured by law. And I don't think our independence would be jeopardized by our coordination with fiscal authorities on the back of COVID-19. I don't say crisis, but COVID-19 shock.
Thank you very much. So both authorities have mandates and they act on their own mandate, and it's a coincidence that it appears they've been coordinating. Janet, can we hear your views?
Yes, well, I would second, I agree with everything that Governor Kuroda said, and I think his comments apply to the US situation as well. It is simply appropriate, given the state of the economy, for the Fed to be purchasing assets and holding interest rates low. And it has exactly the effect that Governor Kuroda suggested. It does make it easier for fiscal policy to be effective because it won't drive interest rates up. But this is not the Fed printing money in order to help the government finance budget deficits, which was, the situation we had in the United States after World War II until the Fed Treasury Accord in 1950. This is the Fed engaging in appropriate monetary policy. I don't think it'll threaten the independence of the Fed. Now, I can't imagine that a day will come. I don't predict it anytime soon, but I hope one day that the US economy is strong enough for the Fed to find it appropriate to raise rates again. And the US government will have a much larger debt than it had at the start of this. We also have, even before the pandemic, we had large budget deficits. We were not on a sustainable fiscal path. That situation will continue into the future and put pressure on the government. I can't imagine a day, and this will be the test of independence, when higher interest rates will be a burden and a problem for the government in financing its deficit, and the Fed will find it appropriate to raise rates. And I believe that central bank independence in the United States is strong enough, has enough support in Congress, is firmly established, that the Fed will be able to do what it regards as the right thing to do. But if that day ever comes, that will be something of a test. You mentioned in your opening comments or your question, losses. And would the Fed worry about losses, and would that compromise its independence? And I just say there that many of the emergency programs the Fed's undertaken, they are emergency programs. There is the possibility of loss, and the Treasury has agreed to these programs, they're joint programs, and Congress allocated $450 billion in the CARES Act to cover those losses, to protect the Fed. Some of the things the Fed does, like buying long-term treasuries, there's interest rate risk there, and there's also a possibility of losses. And when we started engaging in large-scale QE, when I was at the Fed, there were discussions about what should we think about losses, because a day could come when the Fed has to raise short-term interest rates. It pays interest to banks on outstanding reserves, and those interest payments could potentially, in an extreme scenario, exceed the earnings on holdings of government bonds. So there could be losses. And the Fed it was not designed to be an institution with a lot of capital. The Fed's capital ratio is actually under 1%. So it is very thinly capitalized, to put it mildly. But it really is important to realize that a Fed has an economic mandate. It does not need positive capital to operate. It is not like an ordinary bank that has runnable deposits. And central banks tend not to have negative capital. There is a concern it can undermine public confidence. But central banks really should, and we decided to pursue our mandate and set aside that concern.
Thank you, Janet. So I see that, okay, so Trish has a follow-up question or elaboration of the original question, and then Governor Kuroda and the Dr. Yellen, and probably will be, time will be up by that time. Okay, Trish?
So thank you. One final question for me, and thank you. My question about central bank independence, you both answered very clearly, which I appreciate. Both of you were just speaking about the fiscal monetary policy mix in a couple of the previous questions. I want to ask something related to a point that Governor Kuroda brought up in his prepared remarks, and that is the very interesting, if you like, counter-cyclical regulatory policy that has been pursued in many, many countries in a coordinated way, in point of fact, during this crisis. Now, of course, that partly reflects the fact that the financial system was strong going into this crisis. The economy has fallen apart, and the financial system has basically been sort of a support mechanism, frankly, and you'd like it to keep it that way. But as we all know, the longer this crisis goes on, the more likely it is that the financial system will be weaker. And so I'm curious about your views about what additional things central banks, through their traditional lending and monetary policy powers, can do to support a weaker financial system if that happens. And what have we learned that's been useful about this sort of ad hoc right now use of counter-cyclical regulatory tools? And could that be helpful both in this crisis and potentially in future ones?
Thank you, Trish. Governor Kuroda?
I would like to respond to her questions and the prior questions as well. First, Bank of Japan has been purchasing risk assets such as ETFs, J-REITs, corporate bonds, CP, and so on and so forth. And that means that purchases of such risk asset could make loss in the future and so on. Of course, we have been conducting these risk asset purchase using our own balance sheet, and in so doing, it makes adequate provisioning for possible losses to secure our financial soundness. And also, Bank of Japan has been accumulating reserves to enhance capital adequacy. And I must say that from a somewhat longer perspective, central banks can secure their net income profits because of continuous gains from seniorage. Therefore, even if financial positions deteriorate in the short run, this will not be a problem in terms of pursuing monetary policy and ensuring financial system stability. Second, the financial system stability. I think at this moment, the Japanese financial system is, as I said, quite safe and stable. But of course, if the economic downturn caused by COVID-19 continues longer than expected, the solvency of companies could deteriorate and credit costs could rise. Of course, we have to be vigilant to such risks in financial system stability. Having said that, the Japanese financial system has considerable resiliency in terms of capital and liquidity. Also, the government has already taken some measures such as allocating sufficient budget for the provision of capital and quasi-capital fund by government-affiliated financial institutions to the financial system as well as the corporate sector. So these are my possible responses to Professor Mosa.
Okay, thank you very much. Janet?
Sure, just very briefly. I already commented, I think, on losses in the Fed balance sheet, but on bank regulation, the Fed has also encouraged banks to run down their capital buffers and liquidity buffers, which I think is totally appropriate in the kind of situation we're faced. They've relaxed the supplementary leverage ratio as well. But it is conceivable, I'd agree, if this turns out to be a severe crisis, there can be pressures on the banking system. We're very fortunate it started off well capitalized and with a lot of liquidity. And in fact, in the stress tests that were recently completed by the Fed, although they did not do a full analysis bank by bank, or at least present to the public a full analysis of how each bank would be affected in a severe downturn, we could see that from what they presented, that if we have a W or U-shaped recovery, a severe downturn, that roughly 25% of the banks that were subject to the stress test fall below a minimum required common equity tier 1 ratio. And to my mind, the lessons from the previous financial crisis about this is, first of all, this is a time to make sure that banks are not allowed to deplete capital that they have by paying dividends or engaging in share buybacks. And if the next full stress test does show that some banks, and I think there's a big diversity you could see, but if some banks are going to fall below the minimum required ratio in a severe, but nevertheless plausible downturn, I think they should not be allowed to shrink their balance sheets to meet capital ratios, but should be forced to go into the markets to raise capital. I take that as the lesson from the last crisis.
Okay, thank you very much. And we have already going to the overtime. So unfortunately, I have to close today's panel. And I, on behalf of all the audience, that I thank you, both Governor Kuroda and Dr. Janet Yellen and Discussant Tushimosa for great panel. And Before we end today, we'd like to once again express our gratitude to CJEB sponsors, and which makes possible the this webinar series. And actually, I have a great announcement that there'll be another sixth webinar of the summer, and probably the end of this series, season 1, that we will have the 2 experts on the fight against coronavirus in Tokyo and also in New York. And we will have Shigeru Omi, who's really a key person in Japan for designing the policy balancing the fight against coronavirus and reopening the economy. And Dr. Tomoaki Kato, who is the professor at Columbia Medical School, and who actually happened to be contracted by coronavirus and has a first-hand experience of literally fighting the coronavirus. So this will be on August 13th and at the usual time. And we will actually do it in Japanese language. But we hope to see many of you coming back again for the 6th webinar. So keep hold your breath for registration, which is not being prepared yet. So thank you again. Thank you very much for your participation. And thank you for all the corporate and individual sponsors, which are shown on the slide. Unfortunately, we have to close today's panel. Thank you, and see you again next week.